Falling rates are fooling investors. If you're waiting for the perfect buying window, there isn't one. In this video, we'll show you how to navigate a rate dip, creative deals that still work, and why affordability, not the Fed, is your biggest risk.
Stats from Dumbass Dylan here. The average 30-year mortgage just dropped to 6.56%. It's the lowest since October 2024. Well, whoop-de-doo. But average monthly payments are still up over $1,200 compared to pre-pandemic levels. I kind of know why. New home sales dropped in July despite rate relief and builder incentives. Median new home prices are now $403,000, down 5.9% year over year. Inventory is rising in pockets, but still heavily constrained in most markets. We're talking about single-family houses, but who freaking cares, right? What do we care? Do we care about this?
Yeah, I mean, I'm trying to take this stuff and like digest it and understand what it does to commercial real estate, because that's what we invest in. But I think it's important, and part of the reason I think we go into it, the stats on this show is like it's a base, it's at the foundation of what's going on, right? So if we understand housing, if we understand interest rates, then we can understand what's going on, but potentially in the wider market. But with that said, it's like, how does a rate reduction, right? I think in September, that's what we're all sort of expecting. How does that play into the commercial market? How does that play into cash flow investing? How do we set ourselves up for success? I love how the question is like, how do you, it's almost like timing this thing. I hate the concept of timing the market, by the way. I think you can play the market, and we talked about this in reverse, but like, be careful about timing the market, because I think real estate's already adjusting prices and they're pricing in that future reduction. I'm not sure that you can wait for the interest rates to go down and then actually benefit by buying at that time. I think things are going to be priced into. In other words, investors are pricing in that reduction now.
It depends on the asset class too. I mean, this is single family houses. You've got a lot of demand. There's a lot more demand for single family houses than apartment complexes, mobile home parks, commercial assets that we're investing in. But I mean, the fundamentals are the same. I get it.
A small rate reduction, I don't think actually is going to do that much. I think you're going to get some people excited, some buyers excited, but commercial real estate and residential real estate are created very differently. You got to remember, when interest rates were low on the residential side, people were locking in 30-year fixed mortgages. Those homeowners, I don't see all of a sudden selling their homes. They're locked into low interest money on a 30-year fixed. Commercial real estate typically adjusts after 5 years. And so I think on the commercial side, you're going to see some owners, some investors looking to refinance, looking to sell. With lower interest rates, there's more buying power. It may drive some prices up, but we're also looking at like how big of a change, like 20, 25 basis points. Is that really going to do much? Even a half a percentage, is that really going to do a lot for any investor or any buyer?
Well, I think it's like comes down to psychology, and we've got the new big beautiful bill, right, that had just passed. We got 100% bonus depreciation on the commercial side. That's a big sort of tailwind. I think a rate reduction is a tailwind. Once you change psychology, there's a herd mentality. We talked to a couple brokers just the other day. We were deal hunting, and they're saying, look, deals they were dead at the beginning of the year. The big beautiful bill passes. Now we're seeing a bad jobs report. At least the last one. We'll see what the next one shows, which would indicate a rate reduction. I think there's some tailwind for a high demand in the commercial market. Now, the residential might be different, but once that happens, I do think that it turns into a seller's market. In other words, there's a lot of demand pent up, and properties now are moving, whereas in 6 months ago, they did not. And I think it's because of jobs, it's because of interest rate reduction, and it's because of bonus depreciation.
Well, I think the single family housing market, which is, in my mind, speculative and irritating. It's always irritating to us as commercial real estate investors. But I think the single family market is more like a speedboat. Like, shit moves around a lot because you have a lot more emotional buyers. And you said psychology. People are like, oh my God, the rates are down 1/4 point. Let's go. And you're going to have a lot more buyers entering the market, which is going to continue to drive prices up. But I also feel like people don't understand the rate thing. Again, I always go back to this. The feds get together, right? And they press a button, rates go down. But that's the overnight rate. And everything I'm talking about, or that we're always dealing with, is usually tied to the bond markets. And I saw this. I mean, the last rate reduction was in December of 2024, right? The feds, was it 50 basis points? And And I actually have a commercial building, and I have a credit union that's financing this commercial building. Their rates are tied to the 5-year. So much of our stuff is tied to the 5-year treasury. And I remember being naive. I felt kind of dumb after this phone call. Kind of felt like Mitch after this phone call. And I was like, hey, the Fed just lowered the rates 50, and I know better than this, but whatever. The Fed lowered the rates 50 basis points because I pre-negotiated a rate reduction when rates come down with this credit union. And she's like, that's cute, Travis, but the rates really haven't changed much, because people think the Fed's lower the rates, and all of a sudden, at least in the commercial side, rates are going to come down. But it's not. The bond market was still high, and the bond market, again, is how attractive is the U.S., how attractive is the dollar, how attractive is U.S. debt, and it didn't do much. To this day, it hasn't done much. Now, but the bond market is also speculative because people are already pricing in a potential rate reduction. So then that follows suit, and then rates come down.
That's why I think it's a complete fake out. Like, a lower rate isn't really going to help buyers or investors. I don't think that much. Now, if that's what the trend is, and all of a sudden rates start to, trickle down, and a year and a half from now, 2 years from now, we're down several basis points, then absolutely that's gonna impact the investor market. But like, do I think that this September a small rate reduction is going to do much? I really don't. I think it's a complete fake out.
Well, I think the fake out in my mind is that you think you're getting a better deal, but prices will increase to compensate for that. So you're like, look, I could have bought that house for $400,000 at 6.5. Now I can get a 6% loan, but I'm paying $450.
It's basic math. When interest rates were 3%, people had all this buying power and all this easy money. They actually just paid more for a property.
And it always goes back. Yeah. And it always goes back to supply and demand. So if there's a specific demand and a specific supply, then they're going to pay a certain price for that. And that price has to do not just with the purchase price, but also with the monthly payment, with the insurance, with the tax. The other thing too is no one's talking about insurance and taxes, by the way. Every municipality's taxes have gone up. My insurance has gone up. It's interesting. We're all stuck on rates and prices, but that's part of the monthly nut. But it's insane. What were you going to say?
Yeah, 4X. There's some markets,
which is insane.
Commercial real estate insurance has gone up 3 to 4X. Like,
yeah,
who gives a shit about the rates? That's crushing your net operating income.
Nobody says anything. Yeah, she's like, we're like, oh, the rates went up 0.2%, but yet insurance went up 4X.
Damn it, Jerome Powell. Jerome Powell.
Yeah.
And the Mitch's point at the top of the show about not timing the market. And, I love the old adage of like, it's less about timing the market and more about time in the market. And I think when you're actively investing, you take advantage of opportunities when interest rates drop, when maybe that is a time to refinance, maybe that is a time to sell, maybe you have a home, an investment property that's been sitting on the market a little bit, and maybe interest rates drop a little bit, and you have an investor out there that has a little more buying power, and so they're bullish, and they go out and buy that property. I don't think in the commercial real estate we're going to see a big impact. And I also think, and we always say this, like, our best deals are creative deals. Our deals usually involve seller financing, some kind of creative aspect that actually makes the structure of the deal, the financing the deal, better than a typical bank financing type property, whether that's, multifamily, mobile home park, commercial property. It really doesn't matter. Some level of willingness to be able to be creative, and the buyer and seller being able to be creative and coming up with terms that actually make sense. That's where you win in this market and any other market. I don't care if rates are up, down, sideways. Like, you have to get creative.
But going back, though, you both said you don't think this is going to affect the commercial market. Why is that? Because I actually think it will affect it. What do you think? What do you mean by that?
Well, I don't think it'll affect it as dramatically. I think when the Feds lower the rates, all these emotional, uneducated single-family house buyers are going to go in and be like, "Oh, it's time," because there is pent-up demand on the buy side.
But you think the commercial side is not going to be affected as much?
I think it's going to. I mean, look, I've got a $7 million note that I'm refinancing with agency debt. Right. That's a big deal for me. I'm sitting at close to 8% on this thing. I can go to agency debt. We're looking maybe in the mid 5s. That's a huge, massive impact on my cash flow. It's on this 150 unit apartment complex that I own. So yeah, that does make a big difference to me. I'm watching the bond market. I could kind of give a shit about the Feds because I've seen kind of a disconnect between what the Feds are doing and what the bond markets are doing. And people can be pissed off all they want at the Feds. I'm not pissed off at the Feds now for keeping rates where they're at. I think there's some prudency to those decisions. I'm pissed off that they were asleep at the market when we were pumping 25% of our money supply printing money. Like, and the Feds, I don't know where the Feds were. Like, the Feds should have started, being a little more hawkish much early on. And that's why we're in this situation. But at the end of the day, I think commercial real estate, I think when you have less sophisticated buyers maybe, and they see rates come down a little bit and they think now's the time to go. But to your point, Mitch, I think pricing both in the single family house and somewhat in the commercial is already starting to get built in. And to your point, we were talking to multiple brokers the other day when we were hunting for deals, and they're saying more buyers are coming out. More buyers are coming into the market on the commercial side. More buyers, more demand is going to raise prices.
But it's a better deal, though. It's a better deal. I mean, just even in the last 6 months, if they lower, interest rates by 25 basis points, let's just say that prices do stay the same, which I don't think they will. But and we have 100% bonus appreciation. It's a better deal than it was 6 months ago. So right there, you're opening up supply. The same deal is a better deal. And so the other thing too is like sellers got stuck on these old prices, the 2022, the 2021 prices. They were stuck on that. They're like, no, we want this, we want this, we want this. Buyers are going, interest rates are way too high. So in other words, I think that buyers and sellers are closer to a deal on most deals now than they were even a couple years ago, because it's a better deal for buyers, and sellers are tired of waiting, man. I mean, if you're 65 and you want to retire, and you want to sell this property, that's your nest egg. Like, you're probably tired, or potentially something else has changed in their personal economy. A business went south or whatever that is. But like, I think there's more deals today because deals are better deals. If interest rates go down and bonus appreciation, it makes it a better deal.
But there's always deals. We've been buying deals through this rate environment in the commercial side. There's always deals. I think people that, to your point, try and time the market, just like trying to time the stock market, I think that's a fool's game. And I think it's speculative. And we never talk about speculation in the 0 to 100 tribe and with our elite mastermind. We're talking about buying on fundamentals. And by the way, yes, you can creative deal structures, man. Like, I'd say half the deals we've purchased have been seller financing, and creative seller financing is huge. You can adjust interest rates, amortization schedules. You can go interest only. You can go principal only. You can do low down payments. They don't, they're not, LTV, DSCR.
And that's when, like, we're speaking to this audience, when we're talking to our elite mastermind members, like when we're, anyone that's listening to this show, like, I literally, for the most part, give a fuck. I don't pay attention to what the Fed's doing. I really don't care about interest rates unless I may be refinancing or selling. Like I pay attention somewhat, but more so I take advantage of when that opportunity comes. So like, I will refinance when interest rates are low. I will potentially sell when prices are high, although I don't sell often, but it's time in the market. I'm never trying to time the market. There's been multiple instances where it looks like I've timed the market perfectly, but I've just been in the market and I'm going, oh, this is a great time to refinance this property or sell this property. And the actual fundamentals of real estate do not change. So the reason I love creative seller financing, to exactly what Travis just said, everything is negotiable. I've purchased in up markets, down markets, with interest rates above market interest rates using seller financing, below interest rates, interest only payments, direct principal payments. If you have the ability to be creative, you can win in any market. You're not having to sit and wait for Feds to do this and banks to do this and emotional buyers and sellers to do that. If you're a buyer and you're wanting to get into this market, even in 2025, your ability to get creative is where you win. Your ability to have conversations with potential sellers where you get to come up with the interest rate. You and the seller get to agree on the rate term and the interest rate and the down payment and all these things. And then it's basic math. Can you make the property cash flow based on the terms that you set in place and that the seller is willing to agree to?
Well, Mitch and I just did this. We wrote an LOI on a mobile home park portfolio, and we're like, if you want bank financing and you want to be if you want us to go get bank financing and cash you out, this is the price. If you will carry a note and be creative, because this is I think an 80-year-old seller. Again, there's various reasons why an 80-year-old seller would want to sell this portfolio. Then if you want to, if you will offer seller financing, we'll come up on your price. We'll come a little closer to your price. The other thing I think a lot of people don't think about, and Gabe, you're the king of this, creative financing doesn't just have to be seller notes. You can get creative with a bank, because commercial lenders can be a lot more creative. Like if you're going to go buy a freaking house and it's like the 30-year, the FHA rate or the VA rate or the conventional rate, it is what it is. It's a 30-year note. You're not, if you ask for interest only, first of all, they're going to look at you like you have a horn growing out of your head, but with commercial banks, you can say, and we do this all the time. Banks will give you a term sheet. They're like, we're going to give you a term sheet. We're going to give you a loan at this. Your DSCR has to be that. Your LTV has to be this. And we're like, great, that's great. How about you give us 2 years of interest only? Like almost every single time the banks go, yeah, sure. Okay. We'll give you 2 years of interest only, which is great because our strategy and what we teach in the Elite Mastermind is, do a lot of value add, make your most impactful net operating income enhancements within the first, 12 to 24 months. Because we're looking for properties where the net operating income, the profitability is under optimized. Maybe we bring rents closer to market. Maybe there's expenses we can take out that gives us 12 to 24 months with cheap debt, interest only debt to make our moves. And then after that, they start amortizing on a 25-year AM and we're off to the races because we've already done a lot of the impacts in the first 12 to 24 months.
Well, I love what Gabe said too, and I'm going back because
I think what I said.
I think it's really
you like what Gabe said, but you don't like what I said.
I think what Gabe said was really eloquent.
I kind of zoned out when Travis was. I don't even know what Travis said.
Nobody could follow what you said. It was just you got to stop drinking before these shows, man. No, I'm joking.
I'll draw you a picture later. I'll draw you a picture, Mitch. You'll figure out what I'm saying.
It was great, but what I'm saying though is I think that we don't time the market, we play the market. So if you time the market, you're waiting and you're waiting and waiting to make a move. And the market's never the perfect market to buy something unless you create the perfect scenario. So you create a deal, right, that works day one by the fundamentals. By the way, we can go into the fundamentals, but basically it cash flows more than it costs. So it puts money into your pocket and it has the ability, ideally, to put more cash in your pocket over time because rents are low or expenses are high. And basically that's the 30,000 foot level. There's some metrics inside of that, but hey, does it cash flow? Does it give me freedom or does it take away my freedom? Right. And is there opportunity to make it better over time and make it worth more and put more money in my pocket? That's the fundamentals. The point is though, we're not waiting to time the market. We're creating valuable situations via seller financing, negotiating with the bank, whatever that is. And then we're playing the market being, oh my gosh, look at that. Interest rates just went down. Let's go for a cash out refi. Or, hey, interest rates just went down. The market seems totally irrational. Prices are way up. You know what? I'm going to go cash out. I'm going to go 1031 into something else. I'm going to dodge tax or delay taxes, and I'm going to go buy something else.
Don't dodge taxes, Mitch. Don't get yourself.
I did correct myself, but you guys weren't listening. Delay taxes. So you're delaying taxes, but the point is you're looking for situations in the market once you're in the market to optimize that specific asset. But to get in the market, you're creating your own deals. You're not just finding something off the shelf and you're not waiting for everything to be perfect. You go create a great deal.
It's never a perfect market. I mean, I think about those first 4 mobile home parks I've purchased. 3 of those were with hard money, and interest rates were lower for hard money, but they weren't at all-time lows. And so I was buying these properties at 8.25%. 3 were hard money loans. 1 was a seller finance deal. But then I optimized those properties, and those properties, some of those appraised out 2-3x what I purchased them for, and interest rates dropped. So it's being in the market. Had I waited until interest rates were historically low to try to buy these properties, I may not be in a position to then refinance it, pull cash out. So 3 out of 4 of those properties I bought with 8.5% money and then refinanced in the low 4%, pulled out tax-free cash that I could go redeploy into other deals, and the property still worked because they worked at 8.5% interest. They worked because those were the fundamentals I used. It cash flowed there. It also cash flowed. Interest rates dropped to half that interest rate, and I was able to pull cash out and keep the property and let it just optimize and continue to cash flow while I was able to redeploy the capital I pulled out.
But you just said it though. If you would have bought, so think about this, if you did not buy those parks, right? And you waited and you bought those parks once interest rates were really low, what would happen to that price? You would have paid multiple times. In fact, you probably just wouldn't have bought it because it just wouldn't have been a deal. So you bought with high interest rates, you made the fundamentals work, it cash flowed more than it cost to own, increasing over time because of rents and decreasing expenses. Then you refi into a lower interest rate environment, and you're a huge win and you take home a lot of tax-free money. I mean, that's the play.
We got a deal right now. We've got a mobile home park that we're currently refinancing. We've got private money debt on it. It's double-digit interest rates, but it's interest only. So yeah, the interest rate's high, but we're not knocking down the principal loan balance, but it's interest only. But we're actually refinancing with bank debt, and I mean the property works okay. The fundamentals are such that income minus expenses equals your net operating income minus your debt service, money left over. But now we're going to lower our debt service by $2,000 a month, and we're getting 6.7% interest, right? And we're doing 24 months of interest only, and the deal's going to get even better. And so I think people forget about that. And what about the guys and girls that were buying, back in the 70s and early 80s when interest rates were crazy high? They're looking pretty smart right now, right? Because they were buying at subdued values and they've made multiple millions. And so people are like, okay, well, what are the fundamentals, Mitch? We got one bald guy, one hat, one guy with hair. What are the fundamentals? The fundamentals are just that, like, Mitch and I were just whiteboarding we do what's called a back a napkin exercise. We're looking at real estate. We're like, okay, rent rolls are here. Collections are here, expenses are here. What can we do? First of all, we look at what can we do with the net operating income and how can we find something where we can add $1 million in upside over the next several years, like 3 or 4 years, and we found a property. Okay, maybe it doesn't cash flow great, but number one, we know we can drive net operating income up. We can increase the value. Again, every annual dollar of profit is 10 to 20 times the value. We do that first, and then we back into, okay, does the cash flow work? Does income minus expenses minus debt service, does it give us a positive cash flow? Do our investors get an okay return? Our investors don't even care about cash on cash usually until 12 months. And then they want to look at a cash on cash and what their equity multiples are. So you're looking at how fast can you appreciate the asset through forced appreciation? And then what are the cash flow fundamentals, which is things like cash on cash and debt service coverage ratio, things we talk about all the time.
I was going to say, I look at it very similarly, but almost opposite, but it still is the same. And then, like, I'm looking at a property and I'm going, does this cash flow today? Like, that's the first thing I'm curious about based on terms, whether it's bank financing, seller financing, some combination of financing, based on the actuals, based on the real numbers today. So when I talk about fundamentals, I'm talking about cash flow fundamentals. Does this property pencil the day that I purchase it? And then I look at what is the upside? Like, I want it to work if nothing else changes based on the last 2-3 years of profit and loss statements, based on the actual financials. If I do nothing, does this property still pencil? Does it still cash flow? If the answer is yes, then I'm looking in and going, okay, is there an opportunity to increase rents? Is there an opportunity to get better financing to make this even more attractive? Are there things that I can tweak and move to make this deal that works today work better a year out from now, 2 years out from now, and forever into the future? And then that's when it's the green light. And I'm like, okay, it works today and there's upside. I don't like banking on the upside, but I love the upside. It's like, does it work today? And will it work even better a year from now, 2 years from now, 10 years from now?
I agree. I mean, you can get into the DSCR, and we do this in the Elite Mastermind and some of our events we put on too. It's like, we'll sit there and we'll go through like, well, what does this mean? And how do you look at this? And we get into the more philosophy of investing, but the idea is like, how do you walk into cash flow and how do you make it better over time? Travis, you've talked about it a lot. Every dollar to the bottom line annually is $10 to $20 in appreciation. And that's the difference between commercial real estate and residential real estate. And that's why, we talk single family homes, but I'm always like, okay, but how does this affect commercial real estate? Because that's where all three of us have made our money and have built lives. And so I think when you go into these deals, understanding if you got good positive cash flow and ability to increase cash flow, you also have the ability to increase your wealth in multitudes without spending a ton of time. And so every dollar to bottom line, $30,000, I was just doing the math, $30,000, right, at a 7 cap valuation is a $428,000 lift. So if you could look at a property and go, look, I can bring $2,500 to the bottom line per month, that's a $428,000 lift in your net worth. So you're not just like, you're not getting getting cash flow for your life, which is the best thing. You're also building a lot of wealth. And so that's the way we look at these. And when we talk about fundamentals, that's what we're referring to. How do you get into a property versus when I was investing in my 20s, I was not following fundamentals. I was buying vacant land going, oh, this should go up. So that you might as well go to Vegas, right? And it went up and down and all over the place, or development properties, another one, right? Or maybe a single family home that negative cash flows. You're hoping that it appreciates. So you're playing a different game than a cash flow fundamental game.
I was going to say, as we wrap up, I think the important thing, like, for our listeners to remember is that if I could leave you with anything, it's that you can win in any market. And I think a lot of people let interest rates, prices emotionally drive their decisions. I watch people sell off homes with 30-year fixed mortgages back when everyone was just giving homes back to the bank after 2008, just because Zillow told them it was worth less on paper. Their job didn't change, their income didn't change, and their mortgage payment never changed. They were in a fine place financially, but they allowed emotionally to dictate what they did with that property. Zillow shows my house worth less, so I'm going to just give it back to the bank. And so I think if I could leave you with one thing, at the end of the show is don't allow what's in the news, don't allow interest rates and prices dictate solely what you do and the decisions you make, because there's buying opportunities in every single market. There's buying opportunities whether interest rates are up, down, or sideways, when prices are up, when prices are low. It's the willingness to be creative and take action on those things. They're going to put more cash flow in your pocket every single month.
But also stay. If I could leave you something at the end of the show, I would say,
and that's a wrap.
Yeah, no, but also you stay, get educated, and especially if you're a commercial real estate investor, and stay disciplined to the fundamentals. And you can be speculation comes in many forms. Speculation can be like Mitch said, I'm going to buy low, sell high. You don't know that. You can't control that, right? Unless you can force appreciate it, and you have a clear path to force appreciating it only through commercial real estate. But I think something that a lot of, hopefully, investors that went through this last up and down cycle, hopefully they will take away is don't be speculative on interest rates. I've seen this. I saw multifamily syndicators pitching deals, and they were underwriting a refinance in 5 years at interest rates where they were. And so don't be speculative about interest rates. And that's what we talk. That's another less sexy side of the fundamentals, is stress test this thing. What if I buy this property at this 5-year note and this interest rate, what is it going to be in 5 years? I don't know, but I should also potentially expect rates to go up. Like that can happen. And if I add 200 basis points to my rate when I refinance, will this property still cash flow? And that's called stress testing the downside. You can stress test the downside based on loss of revenue through, say, vacancy increases. You can stress test the downside based on interest rates going up. You can stress test the downside on just your general expenses going up. I don't know. Shit got a lot more expensive over the last 5 years. We talked about it. Insurance. If you own a multifamily property, you've got roofs and HVACs and hot water heaters and shit that cost twice as much as it did 5 years ago or 7 or 8 years ago. So you got to hope for the upside, or plan for the upside, have a clear path to the upside, but also have a plan when shit does hit the fan. And shit can hit the fan in a lot of different areas, not just interest rates.
Well, I think too, we talk about interest rates, we talk about the economy, we talk about which way the market's going or which way it might go or where it's been, all these things. But I think that if you're listening to this and you're really diving in and you're really focused on cash flow real estate to get free and to live a big life, maybe you're a mom or you're a dad or whatever that is, but you have responsibilities economically. Here's the thing is whatever's happening in the greater economy, it's your responsibility to create your own economy. And that's created by your own creativity, by your knowledge, by your network. And I think that's been confusing for a lot of folks. They look outward all the time. What's going on in the news? What's going on in interest rates? What's going on with housing prices? All these things versus looking inward and saying, what's my level of knowledge? What's my network? Who do I know? How do I understand how to create a good deal? Do I understand the fundamentals of real estate? Looking inward, you can create your own economy in any economy. And you're responsible for your own economy. And we've all done it in multiple markets. And so be aware of these outside factors, but when it comes down to it, it's all inside. Can you go create a great deal today and then play the market over time to your benefit?
Yeah, go get our book and read about it. We teach you the fundamentals step by step, from going from zero to something to something more, niching down on an asset class, learning about commercial real estate, understanding the metrics that matter, and that really ties into creating your own economy.